Good morning, students. Hope you all are doing good. Today we are going to study books of prime entry, the third chapter. So yesterday itself I have told you that today onwards only we are going to learn the problems. So that is the fundamental that transactions, how to journalize them. We are going to learn. Before going to that particular problem, we need to learn some of the terms. All these terms we have learned already in the basic terminologies in accounting in the first chapter. Okay. So before that, we will learn some of the terms now. Source documents. Because we enter all the transactions, business transactions, isn't it? All business transactions of financial nature only we are going to enter. Of financial nature. Financial transactions only can be recorded in the books of accounts we have studied, isn't it? Financial nature means that money value. Money or money's worth. Okay. All the transactions which can be measured only in terms of money can be recorded in the books of accounts we have learned. So, only the money value transactions only can be recorded. That is why to check their accuracy, because that malpractice, fraudulent actions can be taken place only in this business transactions. Instead of 1 lakh they may write as 2 lakhs, isn't it? So we need to check the accuracy of the accounts. So we need to check the evidences. That's the source documents. Now we will learn what is source documents. They are the evidences, the authentic evidences. That means the truthfulness, that genuine evidence. Okay, authentic evidences. Authentic evidences of financial transactions. That is called source documents. If there is any doubt, or if the auditor comes, he will check with the with the transactions with this source documents whether what is mentioned in the books of accounts is matching with the source documents amount. Okay, so that is the source documents. It is an evidence, authentic evidence of financial transactions. So what these source documents show? These source documents show the nature of transaction. What type of transaction? Whether it is a purchase, cash purchase, or a credit purchase, or cash sale, or credit sale. Okay. The nature of transaction, then when it has happened, date, then amount, and the parties involved. Parties involved. Here parties involved means the one who is purchasing, one who is selling. The source documents will is a summary of all the documents. Okay, we will learn one by one. What are the source documents? That also we are going to learn. So if it is a cash purchase, one who purchased the goods, he will get a cash receipt, isn't it? So that person, one who is selling that goods, he will issue the cash receipt and he will have one as his evidence, one slip. One will be given to him. Then any discount provided. Many details will be available in the source documents. Now we will learn some of the examples of source documents. They are first the cash receipt. If we pay or receive cash, or even for cash purchase also, we are getting the cash receipt. And if we sell that goods on cash, Then we issue the cash receipt after receiving the cash. Okay, cash receipt is one of the source document. Then invoice. Invoice is prepared at the time of credit sale. This one for cash transaction. Credit sale or credit purchase, we will have invoice. Okay. Then debit note, credit note. Debit note, we are going to learn all these in detail. Okay, debit note, then credit note. Then if we deposit money in the bank, pay in slip. Then when we pay salary, that salary bills, wage bills, the institution's wage, salary bills, wage bills. Then if we deposit a check in the bank, check record slip. Check record slip, that the checkbook also we have after issuing check, we will have that detail in one slip. That is called check record slips. Okay, all these are the source documents, examples of source documents. Okay, then we need to we need to maintain these source documents as evidences for the checking in future. And if there is any dispute or if there is any difference in the books of accounts, then they will, the auditors or the accountant or anyone, even the clerk one who is doing his that clerk work, if he has any doubt also he can check with the that source documents. Okay, so it is considered as the legal evidence. Legal evidence, even for any for the legal dispute, for any purpose, not only legal dispute, or if any difference arises in the books of accounts, the auditor has any doubt in the entering of the that amount in the books of accounts, he can check that amount with the source documents amount. Okay, now we will learn one by one. Cash receipt. It is better for you to have the book in front of you. Okay, after when you can keep the book and listen to me, then you will understand more clearly. So this cash receipt, it is also a document and it contains the date, same thing, isn't it? Here you see date, amount, everything, amount, then details of cash purchase, whatever we purchase, details of cash purchase, for how much amount you have purchased, description of goods. Okay, cash purchase and cash sales. Then any other cash transactions, when they, any other cash transactions. This we can say, if they receive cash, we have to issue one cash receipt. Okay, for any type of cash transactions, we need to issue the cash receipt. That is the evidence. Okay, that evidence we can say that is the source document. For any cash transactions, we issue cash receipt. It consists of date, amount, details of cash purchased, cash purchase, cash sales, then the parties involved. In everything, all these source documents will have the heading. Heading means the title, that means the name of the institution, then the address of the institution, and at the end, the right side, who has written that evidence, everything will be entered. Okay. Then invoice. What is invoice? Okay, there itself we have learned, isn't it? The invoice is issued or invoice is used for credit purchase and credit sales. Credit purchase and credit sales. The who is preparing this invoice? The seller. The seller, one who sells goods on credit, will prepare this invoice. Understand? It will have 3 copies usually. One will be given to the purchaser, one who purchased goods. Then another one will be sent along with the goods. Then the other one will be retained by them for the document purpose. Okay, as the source, the evidence. This one is the source document for the selling organization. Understood? So, this invoice, it is used for the credit purchase and sales. The seller prepares it in 3 copies. One is given to the purchaser, one is sent along with the goods, the other one will be retained by the seller for his evidence purpose. Okay. Then here also the details will be given. What the date, everywhere the date will be given, amount will be given. Then here the details of the description of goods. Then if there is any discount allowed, okay, discount percentage will be mentioned. Then the term of payment. Terms of payment means within how many months they have to pay, whether it is within 1 month or 2 month credit period, okay, or 3 month. Time will be mentioned. That is also within that time period, within the given stipulated time period, if the buyer pays back that means the creditor, isn't it? The debtor. If he pays that amount to the creditor, then he will be given this discount. Okay, so that is invoice. The third one is debit note. Debit note. Here this is prepared by the purchaser, one who purchased the goods. Okay, or we can say the debtor. He prepares this debit note. When he prepares this debit note, when the purchaser thinks that the goods sent by the seller, the goods sent by the seller is not up to his standard, up to the standard, or there are any defective goods, or that is not as per his order. He may place an order, no, that is not as per his order. He might have ordered for 10 pieces of goods. He might have sent it 12. So the remaining 2 will be returned back to the seller. Okay, so it is prepared by the purchaser when the goods are not up to the standard, or when if it is defective, or it is not up to that order he has made. Then when he returns these goods, he has to prepare the debit note. Okay, debit note. Why he is preparing this debit note? That he has to mention the description of goods, which type of goods he is sending. Okay, description. Then the amount, everything, the date will be there in the beginning. Okay, date, description, amount. Then that description means that amount, that quantity of goods, how much he is going to send. So the quantity, amount, description, everything he has to prepare, and along with this debit note he will send the goods also to the seller. Okay, why it is called a debit note, you know? Because one who purchases is the debtor, the seller is the creditor for him, isn't it? So that amount, this debit note will will reduce his credit amount. Okay, so that is opposite. Already the seller is his creditor, he has to pay that much amount. Now he is preparing the debit note. To that amount his account must be, they will debit the creditor's amount. They will be having note, for example, they have purchased for 10,000. So now this on credit they have purchased. So now that is seller is, for seller they have to pay rupees 10,000. Now they are returning 1,000. That purchase returns 1,000. So this is becoming the debit note. So now that we are making the opposite entry, now we have to pay only 9,000 to the creditor. Okay, that will debit his amount. To that amount we are debiting the creditor's account. That is why it is called debit note. Okay, now the credit note. Credit note. So now this statement, this credit note is prepared by the seller. After receiving the goods from the buyer, he will prepare this one. That credit note will be prepared by the seller. Then he will enter everything, that date when he has received that goods and that debit note, then the amount, the details of the goods, everything will be entered in a document that is called a credit note. And this document, that debit note also will be sent along with the goods to the seller. Here the credit note is sent to the buyer. They will not send the goods, but they will prepare that one and send it to the buyer, that they have deducted his amount. Okay, then this is also called as credit memo. The debit note is called debit memo, the credit note is called credit memo. Understand? You might have understood the credit memo, credit note. Now the pay-in slip. It is related to the bank. When we deposit cash in the bank or check in the bank. When we deposit cash or check in the bank, we need to fill one slip. Okay, it will have two parts. The main part, both the parts we need to fill. The main part will be, then after filling that, we need to give this to this pay-in slip along with the cash or check to the in the counter to the banker. That is in banker common we are saying, to the counter. In the counter we need to give. Then what the banker does, he will tear the big part and the small slip will be given to us. The small slip will be given to us. This is the source document. Understand? When we deposit cash or check in the bank, we need to write many details in one slip. If you go to the bank to deposit cash, you will understand. There will be a slip we need to take and fill up two sides. One small details, one the large details. Everything we need to fill, and with our signature we have to give the cash and this slip to the banker. He will, after depositing that amount in that particular account, they will return one small slip, that is the source document. They will sign and they will keep seal also in that slip. That is called pay-in slip. Okay. Then check. We know the check. You might have seen, isn't it? Check. One specimen copy is also given in the book, you can see. Okay. Hope you all have the books with you. You see in that book, okay. And what is check? Check, we know that it is issued by the banker to his customer, isn't it? Checkbook will be issued by the banker to his customer. If you open an account in a particular bank, the banker may give checkbook. So that book, whenever we need money, what we can do? We can deposit. We can fill one check, and we can get back the money. It's like a withdrawal form. Understand? When we need money, we can deposit that check leaf and we can collect money. So we are giving that bank is that it is liable to pay that amount either to that same person, even the customer himself. Okay, the customer also he can collect money, or any other person also we can draw a check and we can give. So either the customer or the other person will go to the bank to collect money by delivering this check. So since we can change this ownership, because the customer, not only the customer, he can give that check to the other person. That is why that ownership is transferred from one person to another. That is why check is called negotiable instrument. Negotiable instrument. Understand? So when we issue check to other person, that person can go and collect. That we are giving one command or order to pay that the amount mentioned in that particular check to a person to whom we have mentioned in the check. Okay. So this in the checkbook they will have one page to keep us the details to whom we have issued check for references. Okay, in future to whom we have issued that particular check, because we tear the full check and we will deposit it in the bank. So in future if we have any doubt there in the that one particular page will be given, there we can enter to whom that particular check is issued. Okay, that information will be available. So that will be taken as the evidence. So that checkbook is also an evidence, because we enter the check leaves that we have issued to different people. Okay, now all these, some of the terms we have learned. Now we will go to learn the double entry system. Okay, going to start the accounting double entry system. We know what is double entry system. I have told you many times, isn't it? Double entry system of bookkeeping. What is double entry system of bookkeeping? Because here each transaction, that means all business transactions, have twofold effects. Twofold effects. One may be the receiving effect, or the second one will be the giving effect. Two aspect, receiving aspect, giving aspect. The receiving aspect may be the debit, giving aspect may be the credit. Okay, so the basic principle of double entry system is what? If there is for each and every transaction, there are two aspects, one debit aspect and the other one credit aspect. For every debit aspect there must be a credit aspect. Okay, so debit aspects we can say, what are the debit aspects? Debit, that assets, that will, debit aspect will increase the asset and it will increase the expenses because we debit, or that you are going to learn the rule, that there you will understand very clearly this one. The debit aspect, assets, then expenses, these two will be increased. Then if there is a decrease in liabilities and income, liabilities, income and capital. Understood? If it is a debit aspect, the asset may be increased or the expenses may be increased. But if the liabilities decrease and income decrease and the capital decrease, it will be a debit aspect. Then what will be the credit aspect? If it is a credit, the asset will be decreased, opposite. The asset will be decreased, the expenses will be decreased, but the liability will be increased. The liabilities will be increased, income also will increase, and the capital too will increase. Okay, that what is double entry system? You know, for each and every business transaction there are two aspects. One is receiving aspect, the other is giving aspect. Okay, then the receiving aspect is denoted with the word debtor. Then the giving aspect is denoted with the term creditor, CR. Okay, the discard debit, credit. Okay, debtor, creditor. Here that why that word DR came, that one small thing is given, DR, debit, why that R has come? This word has come from the Italian word ad debitor. Okay, the Italian word. Then the Latin word deber. Latin word deber. It is the basis for this debtor word. Okay, that is short form debtor given. That is the root word ad debitor, Italian word, the deber, Latin word. Thus the R, DR. Here also DR is there. So they have given debtor. Okay, there is nothing related to the creditor. Already credit, CR, the short form CR is there. Okay, that's it. This word DR, you may not get that doubt. No, debit, only DBIT is there, R is not available. So from this word only that DR has come. Okay, now I will explain the definition. Just the first definition I will explain. Here nothing to learn by heart. Okay, just to make you understand. Okay, every transaction involving money or money's worth has two-fold aspects. The receiving of a value on the one hand and the giving of the same value on the other. This twofold nature in all transactions must be recorded in the books, and this gives rise to the term double entry bookkeeping. Okay, what is the meaning? For every business transaction that involving money or money's worth, only that one only we can record, isn't it? These two have twofold aspect. One is receiving aspect, other one giving aspect. Then this twofold nature must be recorded in the books, and this only gives rise to the term double entry bookkeeping. Okay, Munro and Palmer. The other one, other definition is given by J.R. Batley Boy. Every business transaction has a twofold effect, and that it affects two accounts in opposite directions. And if a complete record is to be made of each such transaction, it is necessary to debit one account and credit another account. It is this recording of twofold effect of every transaction that has given rise to the term double entry. So you might have understood what these two definitions say. we are entering the business transactions two aspects. Okay, that is called double entry bookkeeping system. Okay, now we will learn the principles of double entry system. Principles of double entry system. In the definitions we have learned, no, that one only will be coming. You know, what is the first one? For every business transaction, there are two aspects. That is the first principle. It is one of the question answer. Okay, 3-mark question, fifth one. 3-mark question, fifth one. You have to learn. For every business transaction, there are two aspects. Then, that those two aspects are the benefit or value receiving aspect, benefit or value receiving aspect, one, then the other one benefit or value giving aspect. Okay, the two aspects involved are the benefit or value receiving aspect and the benefit or value giving aspect. Okay, two aspects. Then the third principle is these two benefits. Okay, these two benefits involve minimum two accounts. It will affect minimum two accounts. That's what. These two aspects affect at least two accounts. In one, if one minimum one debit and one credit will be there. Okay, at least one debit and one credit aspect will be there. Okay, then the last one. For every debit, there must be equal and corresponding credit. Corresponding credit. Understood? For every debit aspect, there will be equal and corresponding credit value. Here, once again I will explain. Okay, this each and every business transaction has two aspects. These two aspects involved are the benefit or value receiving aspect and the benefit or value giving aspect. Then these two aspects involve minimum two accounts, at least one debit and at least one credit. Okay, one debit and one credit will be there. Then for every debit, there is a corresponding and equal credit. That means if it is debit is for 10,000, the credit also must be 10,000. Understand? For example, we receive the cash from the creditor. Okay, and we give discount also for them. Okay, when we receive cash, we are receiving cash account debtor. Okay, we are receiving only 9,000. The 1,000 will be the discount. So discount 1,000. This both debit. What is the credit? The creditor, one who is giving the amount. Now the debtor, one who pay the amount. The debtor. Okay, he is the giver. Credit the giver. That I will teach you that rule. So cash we are receiving 9,000. Discount 1,000. That is a loss for us. Totally the debtor is giving. That we need to cancel his account. That is 10,000. How? Here one credit and two debit. To check, say this third point only I have told you that one, and here also. That is equal, no? Equal and corresponding credit. One debit, here two debits are there, one credit is there. Okay, two debit account. At minimum two accounts, one debit, one credit. See, one debit, one credit, extra one debit. Okay. Today we will finish with that one. So you can mark the question answers. The first one, very short answer, first one. What are source documents? Source documents are the authentic evidences of financial transactions. Three, 4 points available. Okay, mark everything and you learn. Then the next question answer, double entry system. What is double entry system? Short answer, 7th one. Double entry system of bookkeeping is a scientific and complete system of recording of financial transactions of an organization. According to this system, every transaction has a twofold effect. That is, there are two aspects involved, namely receiving aspect and giving aspect. It is denoted by debit and credit. That one. Okay. Then the principles. All the 4 principles. That one. Short answer, 5th question. Okay. Principles. That 4 points you have to learn. Okay, students, learn up to here. Then the remaining theory portion, and I will start that remaining portion tomorrow. Okay, students, thank you very much.